You've probably heard how ESG and sustainable investing once stood as hopeful beacons for a brighter, more sustainable world. But lately, it seems like they're navigating through a storm with increasing skepticism and controversy clouding its path. So, the big question we're tackling today is sustainable investing fading into the background? Or are we on the brink of witnessing its evolution into something even more impactful? We're about to delve into the tale of its rise, the hurdles it has encountered, and the shift towards what's being called rational sustainability. But first, let's break down what we mean by sustainable investing. It's a term that's been buzzing around, but what does it really entail? Imagine a world where your investment not only grows, but also plants the seeds for a greener planet and a more equitable society. That's the heart of sustainable investing. In essence, sustainable investing is all about striking a balance between securing financial returns and nurturing long term environmental and social values. It's where the traditional world of investing meets the insights offered by ESG criteria. This fusion allows investors to conduct deeper, more comprehensive analysis and make decisions that don't just benefit their portfolios but also contribute positively to our world. But it's not just about the money though. Sustainable investing challenges us to look beyond the short term financial metrics and consider the wider impact companies have on our society. It's an invitation to investors to think critically about their investments ripple across environmental, political, and social landscapes. Let's rewind a bit and talk about a time when ESG investing was the superstar of the financial realm. Imagine this, investing your money not just for a solid return, but also to fuel positive changes for our planet and society. Sounds pretty great, right? Well, that was the magnetic pull of ESG investing, which saw a phenomenal surge, capturing the imagination of investors all around the globe. Adding to that, let's put some numbers into perspective. According to Morningstar Direct, there was a moment when a whopping 8.3% of all new funds launched in the US and Europe were waving the ESG flag high. This wasn't just about hopping on a new trend wagon. Oh no. It was backed by solid research showing that the companies dialed into ESG were actually outperforming their competitors. They were not just ready for the future, they were shaping it, turning resilience during crisis and alignment with sustainability into their superpowers. And speaking of shaping the future, Larry Fink, the CEO of BlackRock, and yes, we are talking about the world's largest money manager, made a bold statement back in 2020. In his annual letter to corporate chief executives, he said, climate change is different from other financial challenges and pledged to fundamentally reshape finance by placing sustainability at the heart of their investment strategy. This wasn't just talk, it spurred a movement with corporate America and SEBI investors following suit quickly, scrambling to sign up to net zero carbon plans and launching funds that included environmental, social, and governance factors in their investment decisions. Sounds good so far, right? Well, 3 years later, BlackRock is still betting big on the transition to a lower carbon economy, but the 9.1 trillion USD money manager's emphasis when it talks about the sustainability social issues has changed. In fact, last November, BlackRock made headlines with a hefty USD 550 million investment in one of the largest carbon capture projects out there, right in the heart of Texas. But here's where it gets interesting. Instead of focusing on the project's eco-friendly credentials, this time Larry Fink spotlighted the investment's potential for profit, calling it an incredible investment opportunity. Fink also underscored BlackRock's commitment to continuing collaborations with big energy titans. Now, this shift didn't just come out of the blue. It has been brewing amid a storm of political pushback. Over the past couple of years, some of the loudest voices in US politics, particularly from the Republican side, have taken a stand against what they perceive as the financial sector's overly progressive stance, or as they put it, being too woke. They have been especially vocal against the industry's negative approach to fossil fuels. In fact, treasurers from the red states, think of Texas and Florida, have been putting financial behemoths like BlackRock, Goldman Sachs, State Street, and Wells Fargo on their blacklist. And it doesn't stop there. The political battlefield has widened with recent moves aiming directly at the heart of sustainable investing. A case in point, legislator in New Hampshire threw down the gauntlet with a bill proposing to make it a felony to invest state or taxpayer funds based on the ESG criteria. Yeah, you heard it right, a felony. Now let's move away from politics for a bit and shift our focus to the clean energy sector. It's been a rough ride for some of the biggest names in this sector and for the entire S&P Global Clean Energy Index. Think of major players like Tesla, First Solar, and Vestas. Since the start of 2023, the ICE index has seen a drop of 31%, all while global stocks in general have actually gone up by 27%. It's a stark contrast that's left many wondering about the viability of these once booming clean energy investments. But it's not just the stock market feeling the chill. The buzz around ESG in the corporate world, measured by how much is talked about in the earning calls, has significantly cooled off. We have gone from nearly 35% mentions at its peak in early 2020 down to less than 10% by the end of 2023. And over in Canada, the market for green bonds, these are bonds specifically aimed at funding eco-friendly projects, has hit its lowest level since 2019. Meanwhile, the US has seen a notable pullback in ESG fund investments amid raising concerns over greenwashing. On the other hand, under pressure from EU regulators, some of these funds are starting to rebrand, and few are even stepping away from the ESG level altogether. Why, you ask? Well, it turns out that what they're championing might not be all about saving the planet, but rather how the planet's changes are impacting them. And remember the impressive figure of 8.3% of all new funds being ESG leveled we talked about? Well, that's now down to just 3.3%. What about online searches for ESG investing? They plummeted back to 59% from their quarterly peak in 2022, levels we haven't seen since mid 2019. It's a significant shift, signaling a broader reassessment of what sustainable investing means and where it's headed. However, not everything is all doom and gloom. Research by McKinsey reveals something incredible. We're not just on track, we're actually charging ahead with fresh capital pouring into the green investments at an unprecedented rate. McKinsey puts the need for a net increase of USD 3.5 trillion annually. So far, the trends are promising and meaningful to meet the need for innovation in everything from battery storage to next generation nuclear to decarbonizing the use of fossil fuels. They've also mentioned the incentives are now better aligned and capital for new infrastructure is actually flowing. McKinsey writes, the current momentum in climate-focused investing suggests that the space is breaking out, not breaking down, in the face of market complexity. And there's more. The investment landscape is evolving with a growing emphasis on aligning with companies' real-world performance over mere stock market metrics. This shift towards a long-term orientation and active engagement is setting the stage for a deeper, more meaningful approach to ESG investing. Meanwhile, with the narrative around ESG beginning to fray, a critical dialogue emerged within the investment community. Was the issue with the concept of ESG itself, or with how it was being implemented or perceived? This question has been answered by the introduction of rational sustainability, a concept introduced by Mr. Alex Edmonds, a professor, academic, and economist who is a professor of finance at the London Business School. This concept suggests a fundamental change. It's about creating long-term value, not by just ticking the ESG boxes. It's where sustainability aligns with all the job titles, political learnings, and is inherently about value creation. This concept pushes us beyond the surface level ESG levels to focus on actual outcomes. It's about being the intrinsic, core, and enabling, not just adhering to a level for the sake of it. Rational sustainability encourages us to look at investment and corporate practices through a lens of long-term value creation, where every decision is deeply analyzed for its real-world impact. Now let's break down the features that make rational sustainability stand out. From focusing on value creation over politics to settling clear boundaries and reorganizing diminishing returns, it's a comprehensive framework that champions evidence-based analysis and rational decision-making. One of the most compelling aspects of rational sustainability is its emphasis on being rational. It's just about making decisions based on evidence, acknowledging the trade-off, and being wary of irrational sustainability bubbles. It's a call to action for investors, companies, and policymakers to challenge the status quo, question unsustainable practices, and ultimately make more informed decisions that lead to sustainable long-term growth. So what does this mean for us investors, entrepreneurs, and just global citizens? It's time to embrace rational sustainability as the path forward. By focusing on creating real value and approaching sustainability with a rational, evidence based mindset, we can drive meaningful change and ensure a more sustainable future for all. Moving on, the global challenges we face, from climate change to social inequality, demand innovative solutions that sustainable investing is uniquely positioned to support. Companies that can navigate these complexities, integrating ESG and rational sustainability principles into their DNA, are likely to emerge as leaders in the next wave of economic and societal progress. So is sustainable investing dead? Far from it. What we are witnessing is not the demise of an ideal, but its evolution. As we move forward, the key will be to learn from the challenges and criticisms of the past, building a more robust, transparent, and impactful approach to investing in our collective future. In conclusion, sustainable investing is evolving, not vanishing. Embracing rational sustainability marks a new dawn, promising a future where investments create lasting value and contribute to a sustainable world. Together, let's shape an investment landscape that thrives on rational and impactful choices. The journey continues and is more promising than ever before.